This is Bloomberg Wall Street Week.
We may not have an overall recession. We're having a rolling recession. The economy overall looks pretty strong, at least when it comes to jobs.
The financial stories that shape our world.
3 major regional bank failures sent shockwaves through the banking system. We're all trying to figure out what to make of generative AI.
Through the eyes of the most influential voices.
Welcome now, Dr. Paul Krugman, Brian Moynihan of Bank of America, Deborah Lair of the Paulson Institute, Glenn Hubbard of the Columbia Business School.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Momentum. Donald Trump has it, Netflix has it, the U.S. economy has it, and China's trying to get it back. This is Bloomberg Wall Street Week. I'm David Westin. This week, former Treasury Secretary Bob Rubin on the need to get the U.S. fiscal house in order.
Once you get to legislating, there isn't the will. There's a lot of talk, but the talk is always divided politically.
Purnima Puri of HPS Investment Partners on private credit trees growing to the sky, and Sharmin Mossavar-Rahmani on investing into a rising market. Global Wall Street saw some impressive performances this week as former President Trump continued his march to the Republican presidential nomination with a big win in New Hampshire, even as his remaining rival, former UN Ambassador Nikki Haley, said, not so fast.
This race is far from over. There are dozens of states left to go.
Netflix showed that not all streaming businesses are troubled, as it posted big fourth quarter wins on subscribers and on revenue.
We're really thrilled with our engagement trends domestically and globally. Our engagement is a bit impacted by our paid sharing. Think about it like fewer households using the same account. So as those folks spin off and get their own accounts and we win them over with our programming, that will normalize and continue to grow.
Even as the streaming giant moved into the world of live entertainment with a big deal with the WWE.
We're pleased with the deal, and we love the fact that Netflix was willing to take a bet on us. For us with Raw, it was yet another test of someone new in the space, obviously an established streaming entity, the streaming entity, if you will. It was a good bet by us, and we think a good bet by them.
China recognized that it needed to get some momentum back by cutting its bank reserve requirement ratio in a bid to boost its economy.
There is still sufficient room for China's monetary policy in the next stage, and we will continue to strike a balance between short-term and long-term, between stable growth and risk prevention.
But the U.S. economy continued to show its strong momentum with surprisingly robust GDP growth numbers for the fourth quarter.
Well, we got to look at GDP first because that's what everybody has been watching, and it's up by 3.3%, a significantly higher number than anticipated.
Equity markets spent most of the week marching higher with just a little bit of a sell-off on Friday. For the week, the S&P 500 was up just over 1%, ending up at 4890, which is only 60 points away from the median consensus estimate of the Bloomberg Els for the end of the year. The Nasdaq rose just under 1%, and the yield on the 10-year rose just 2 basis points to end up at 4.14. Welcome back now, Saira Malik, CIO of Nuveen, to help us sort all this out. So, Sarah, thanks so much for being back with us. I guess my question is, when it comes to equities, what is causing all this momentum? It just keeps coming.
Good to see you, David. Well, the January effect is in full force this month, and it's been driven by the bellwether technology sector. There's been 3 reasons for the rally. First, inflation is moderating. Second, the economy remains surprisingly strong. And third, expectation for rate cuts. Now, we got 2 data points this week that support that narrative. PCE, which is the Fed's preferred barometer of inflation, came as expected, and GDP blew past expectations, coming in at 3.3%. So where do we go from here? Well, we have an FOMC meeting next week. I think the Fed continues to watch and wait. There's no reason for them to start talking about rate cuts at this point with the economy so strong, and also with inflation, while it's moderating, I think they'd like to see more of a consistent trend. So when we're going past earnings season with 40% of market cap reporting next week, I think it's going to be tough to find a catalyst after that. S&P valuations at about a 20% premium to average. I think that's going to be your headwind going forward, and that'll cause the rally to peter out eventually.
So, Sarah, before we get to what comes after, let's talk about next week in tech. You mentioned technology being a big driver. We've got some big tech names out next week. What are you expecting?
Well, it's a high bar for earnings season in general, where consensus expects earnings to grow by about 5%. And what we're seeing is the haves and the have-nots. So the haves are the companies beating sales and earnings. Those stocks are going up by about 2% when that happens. The have-nots, companies missing on sales and earnings, are dropping by about 5%. So next week, all the mega cap companies, Amazon, Apple, Alphabet report, I think they are going to be the leaders for earnings growth, but we prefer Amazon and Alphabet over Apple. Apple, I think, still has headwinds. Huawei coming back into the market could cause them to lose market share. And importantly, iPhone at 50% of their profitability has been normalizing to flat unit growth post the COVID bump. Also, we're worried about their app store and the profitability there given regulations. Now, Alphabet and Amazon, they're benefiting from a cyclical upturn in advertising. Also, Amazon finally bearing the fruits of their investments in their retail business. All of that, I think, positive for Alphabet and Amazon.
Sarah, what about some of the risks, the downside risks for equities, and particularly are those expectations about rate cuts? I mean, there's been a back and forth between the Fed and the markets here about what's coming up. What is the risk here that, in fact, the markets may be disappointed?
I think that's a good risk that is definitely out there. We came into 2024 with the market expecting 6 to 7 rate cuts this year, starting in March. As of today, the March rate cut is now a 50-50 chance. So we're already starting to push those out. I don't think we're going to get 6 rate cuts with the economy functioning so strongly. Second risk for the market is valuations. We came into this year with S&P valuations at about 20% above average. That's going to be a headwind for the markets. And also, let's take a look at yields. The 10-year yield now backing up to about 4.2%. That's a headwind for equities too. So that's why I said post earnings, the catalyst for the next leg up for equities to cross 5,000 on the S&P is hard to find.
Sarah, it's always such a treat to have you with us on Wall Street Week. Thank you for being here. That's Saira Malik of Nuveen. U.S. equities had a pretty good run in 2023, which has led some people to think about taking some money off the table at those high valuations. For a different view, we welcome back now Sharmin Mossavar-Rahmani. She's Chief Investment Officer of Goldman Sachs Wealth Management. Great to have you back with us, Sharmin. Let's look at your your outlook. America powers on. We're going to put the image up for those who can see it on the screen. 1959 Cadillac, one of my favorite cars of all time. So give us your sense about why you think, boy, it's time to stay with U.S. equities.
First and foremost, our view of U.S. preeminence is intact, and that's why we chose that car. It is such an American-looking car. It's so clear. It can't be confused with cars from any other place. It also shows that America has been preeminent for quite some time. We have a great quote from Bruce Springsteen's song Pink Cadillac there, where people are saying, oh, after the global financial crisis, this was the end of the American century, and the century belonged to China, and our view is actually no, U.S. preeminence is going to continue for the long run, and that's driven by a number of factors, but that results in great earnings per share growth, very consistent, persistent, reliable growth, and that's why one should stay invested.
So if you look backwards, which you do in your outlook, actually, you have remarkable numbers. If you take on $100 million, you correct me if I'm wrong here, back in 2009, it would be worth just under $1 billion today invested in U.S. stocks, as opposed to if you took a developed markets, equities non-U.S., it would be $400 million, I believe. And if you did it in developing markets, it would be 318. China at 229 million, as opposed to just under $1 billion. That's a pretty extraordinary performance.
When we show these numbers to our clients, they are so surprised because, as you say, 100 million would be just under $1 billion just in U.S. equities, and not even a quarter of that in China. And for everybody who thinks of China's growth rate, it goes to show that economic growth alone doesn't drive equity markets or earnings per share growth. And so that's why when we tell clients stay overweight U.S. equities from a strategic long-term perspective, they look at that data and it's easier to persuade them to do that.
Such an important thing you said, stay in it. Because one of the questions is it time to take the money off the table? Because we always hear that disclaimer about past performance and future. And why isn't this a time to say, oh, you know what, I did pretty well in equities, I should put the money someplace else?
So there'd be 3 places people could put their money. One would be you could put your money in non-U.S. equities. And that is a function of whether you think earnings per share growth will be faster. Do you think economic growth is going to be more sustainable? Does one think that valuations are more attractive? Another place would be bonds and another would be cash. And we actually make the case that even though the returns for U.S. equities relative to all these other assets has been outsized since the global financial crisis, we still recommend stay with U.S. equities. And the argument there is that, first of all, when you're looking at cash and bonds, you're going to have substantially lower returns over the long run. Second one is you look at other parts of the world, even though valuations look expensive, you need to adjust for sector weights, meaning U.S. S&P 500 benchmarks have a lot more earnings from technology stocks. So you have faster growing companies, faster growing earnings per share relative to, for example, the UK equity market. It's really remarkable. S&P 500, when you look at the earnings, about 30% comes from technology. In the UK equity market, only 1%. So when you're looking at benchmarks, you need to adjust for sector weights. And then the U.S. is expensive, but not that expensive relative to other markets.
See, that was one of the things I got from your report I had not focused on, because I hear it's expensive, it's fully valued. If you look at price earnings ratios and things, it's pretty, historically, it's up there, right?
Yes.
According to where we've been historically. But you're saying if you really look at it the right way, it's not as expensive as you think it is.
Yes, it is correct that it's expensive. So if we look at its own history, it's what we call in the 10th decile, meaning equities have been cheaper 90% of the time. But when you look at it relative to other markets, you can't just look at the price to forward earnings, for example. You need to say, well, if an index has a lot more technology versus another index that has a lot more energy and financials, the one with a lot of energy and financials will look cheaper, but that's only because it has slower earnings growth. Once you make that adjustment, these other markets don't appear as cheap. Of course, China is the exception, but we actually don't recommend clients invest in China no matter how cheap it looks.
No, that's not too good. So there are some risks in your outlook, and it struck me in looking at them, it looks like they're pretty much all either geopolitical or straight up political.
That is correct. We start with all the things going on in the Middle East. So we start with the Israel-Hamas war. We look at Iran. We're saying, what is the risk there? What about Iran-Russia relationships? What does that mean? So everything related to the Middle East is on that list, and fears of escalation. It's not as if there's zero probability of even further escalation beyond what we've seen. Obviously, with what's going on in the region, risk of terrorism goes up. And then domestically in the U.S., we have it as our lowest risk. Even though people are very concerned about it, we don't think this kind of pessimism is warranted. There'll be volatility around the elections, but at the end of the day, the system of checks and balances in the U.S. and the strength of the institutions is what makes the country preeminent. So we think clients need to look past that and past that volatility.
Thank you so much, Sharmin. Really great to have you back with us. That's Sharmin Mossavar-Rahmani of Goldman Sachs. Coming up, they say U.S. deficits are unsustainable. We talk with the man who helped design the last serious attempt to deal with the debt and deficits, former Treasury Secretary Bob Rubin. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
$34 trillion. That's what the U.S. government owes its creditors, foreign and domestic, and it's only getting worse.
The problem is that's led us to years and years of borrowing too much. We now have a debt that's about to be at record levels. Interest payments that are the fastest growing part of the budget, about to be larger than defense.
Some say that the problem is that we're spending too much.
You have to start cutting what you spend. Why is it everybody in this room balances a budget? I balanced a budget as governor of South Carolina. Why is Congress the only group that refuses to balance a budget?
Others point to the Trump tax cuts.
There were a lot of people who basically, on Wall Street, who you and I would know, who voted for Trump once or even twice, and basically, look, I don't like the guy, but I like the policies, and they got what they wanted. The TCJA, the Tax Cut and Jobs Act, being the most prominent.
And the answer likely is both, which was why President Clinton both raised taxes and cut spending in his 1993 Omnibus Budget Reconciliation Act, the last time that the federal government really got serious about addressing the debt.
I think he laid out the case. He brought people together. He was willing to do things that were painful for the people who were his friends. He was able to explain the case to the American people.
And to explain to us where we are in the debt and deficit and where we were back in 1993, we welcome now one of the architects of that plan that President Clinton pursued. He is Bob Rubin, former Treasury Secretary. So, Bob, thank you so much for being on Wall Street Week.
David, happy to be with you.
So at the time, you actually were Director of National Economic Council, and you helped put together a plan with Lloyd Bentsen at Treasury. But President Clinton really pushed it through. Give us a sense of how bad the problems were you were facing then, what caused you to do what you did in the 93 Act.
David, we met with the President-elect, Governor of Arkansas, in Little Rock after the election, the economic team, the income economic team, and we talked to him about what kind of an strategy he should have. And he said, after listening to all this, our deficit is a threshold issue. And if we want to do everything else, we've got to do that because we have to get our fiscal house in order. And that was really our focus. Now, we did it in the same time we did public investment. But the pressures, I think, were very substantial. There was a lot of concern in the business community. There was a lot of concern in the markets. And there was a real public political environment, which unfortunately we don't have today, to address the. So that you not only had the substance of it, which is President Clinton's view that this was the threshold issue, we also have a political environment in which it was doable.
If we can, try to tease those two things out. How much of it was the market reaction, what you were seeing, basically? We have the famous incident, supposedly, where Jim Carville said, I want to come back to the bond market.
Well, that was James said that he wanted to come. Well, because what happened there was we were having a debate within the administration. Should we focus on fiscal matters or should we focus on public investment? We ended up doing both, but with a program, the 93 deficit reduction program, that was very heavily focused on deficit reduction. And that's when James said he wanted, because we argued, and I think rightly argued, and it turned out to be correct, that markets would react very favorably if we were serious, and also that the Federal Reserve would react very favorably. So James, in response to all that, said he would like to come back and his next life is the bond market.
So that is a somewhat market-oriented approach. I mean, you'd come out of Goldman Sachs, you knew the markets terribly well. You took that sort of approach to the whole question. How much of that drove what it was? Was it really just almost dollars and cents in what was going on in the markets?
Well, it was more than just the markets. And I think this is something, unfortunately, that hasn't been focused on. But it was the markets, David. And when we got serious about deficit reduction, it was very favorable for the markets. And also Greenspan reacted very well in terms of maintaining a relatively livable, maybe the wrong word, was a practical speaking, a Fed funds rate that was consistent with growth. But it went way beyond that. We wanted to have the resilience. After all, if you have an economic or national security emergency of some sort, you want to be able to deal with it without creating fiscal havoc. And another thing, when I was at Goldman Sachs, and Steve Friedman and I were the co-CEOs of Goldman Sachs, in 91 and in 92, one thing that I had the impression of was that business was very concerned about our fiscal position, not only because of the fiscal position per se, but also because it gave them the feeling government was incapable of dealing with our problems. So business confidence, I think, was a very important factor. And once we acted, I think it had a really positive effect on business confidence.
Well, give me a sense of what that means as a practical matter. Does that translate into investment or lack of investment practically?
Yeah, that's exactly what it is. Well, investment, plans in terms of expansion, and generally just John Maynard Keynes famously referred to animal spirits in his famous letter to President Roosevelt. And animal spirits make confidence makes a very big difference. And yeah, it does in terms of hiring plans, expansion plans, investment. And that absolutely is what happened.
Give me a sense of what was going on politically in the country that obviously President Clinton was reflecting to some extent what he thought the people felt.
Yeah, I think there was a feeling there was a broad public concern about our fiscal position. And then Paul Tsongas ran for president on a fiscal, he unfortunately died, as you know, in that process, but on a fiscal discipline plank, if you want to call it that, or program, let's say, and that attracted a lot of favorable attention. Then Ross Perot came along, and he ran also on a fiscal discipline theory, and he got about 19% of the vote, if I remember correctly. President Clinton believed it to begin with, but then you had the politics, I guess you'd call converge around this point of view, as you saw Tsongas and then, as I said, Perot, and President Clinton made that central to his economic program.
Now let's bring it forward to today, because there's a lot of talk about the debt and deficit, which is frankly a lot larger, both in nominal dollars and in comparative dollars, than it was back then. Let's talk about what you learned in 93, what you did in 93 that could conceivably be applied to 2024.
It's also a lot bigger, David, and this is the really important thing, as a percentage of GDP, the percentage of our economy, and that I think is the critical point. I think that the risks that we identified then, the multiple risks, are the same as they are today. I think that the risks are even greater today because our debt-GDP ratio, CBO estimates at about 100% right now. It's the highest in the history of the country except for 1946 and 47 when we were coming back out of World War II. I think the risks are enormous, and some of them are materializing already, like higher interest rates and effect on inflation, in part, not in full. And others haven't materialized yet, but I think they're out there and sooner or later will materialize if we don't correct our fiscal trajectory.
You talked about some of the market indicators and even forces that you saw in 93 that sort of pointed you in a direction, pointed President Clinton in the direction of really making the deficit a threshold issue. Are we seeing those indicators of those forces today in the markets?
I think that we are seeing the effects, but it's unfortunately from a political point of view, David, I don't think they're getting connected in a meaningful way with deficit reduction. The 10-year was about, I think, 1.5%, say, 2 years ago, and now it's about 4.5%. Now, that's a lot of factors that go into that, but I think part of it is our fiscal situation and the effect that's had on inflation. I think it's been an aggravator of, or if you will, an effect on inflation. And I think there's a general concern about the imbalance between supply and demand for savings and the excess demand that's created by our deficits. Unfortunately, from a political point of view, I don't think the dots are being connected the way they were back in 92-3 when we acted. Well, 93 we acted, but 92 when President Clinton was putting his plans together.
There's a lot of talk these days when we talk about the Fed about the neutral rate and a debate about whether is the neutral rate higher. And I guess my question is, does the deficit and the debt normally, all the things being equal, drive the neutral rate higher?
I think over time. But I think you can also have a long period of time, and we had a long period of time, David. We had actually a long, long period of time, during which all this was having little effect. And then all of a sudden, the 10-year went, as I said a moment ago, from roughly 1.5 to roughly 4.5. And there certainly are periods when you can have a long time when what's happening is out of sync with reality. But that doesn't go on forever. And when it corrects, it can correct savagely. A good example was the the sovereign Eurozone crisis. For years, the Greek bonds traded, roughly speaking, parity with give or take, with German bonds, and then all of a sudden it exploded. And I think it's a good example of how what isn't sensible ultimately doesn't continue.
There's the politics of it, which I want to talk about. Before that, let's talk about the approach taken to it. Let's talk about, for example, the Biden administration. We can talk about the Trump administration if you want. Sure. The Biden administration. When you were there back in the 90s, you came from Goldman Sachs. You had other people there who knew the markets pretty well. There was a healthy dose of how are the markets reacting to this? What does that do for us? Do we still have that, or is it more ideologically driven? Because some people think we've sort of shifted the orientation, particularly the Democratic Party, more toward protectionism, more toward populism.
Well, you've asked multiple questions, so I'll give you my view. I've given a lot of thought to this, and I know the people there pretty well. If you look at the proposals, the major policy proposals that President Biden made, they were all paid for in the proposals. Now, ultimately, they had to go through Congress, and when they went through Congress, they came out, some of them paid for and some of them not. I think he's okay. I think he's actually pretty good on this. I think there are other issues where I might have a different view than he does. But I think on fiscal stuff, actually, he's got a pretty good sense of it. I think on the proposals, they had three major bills, IRA, CHIPS, and infrastructure. And in the original proposal, and then, of course, before that, Build Back Better, the proposals were fully paid for. They had to go through Congress, and in Congress, in some cases, they lost the pay-fors. You know, you mentioned populism or progressive.
Populism, yeah.
Yeah, populism. If you look at what is being referred to as industrial policy, and they refer to as industrial policy, it's their label, yes. But it's not picking winners and losers. Now, it may be in the minds of some of those people, but if you look at those proposals, and I've talked to their people about this a lot, I think they actually make a lot of sense on a purely economic basis. They're externalities. They basically dealt with with insecurities in our system, in our economic system, with respect to our economic security, our economic functioning, our geopolitical or national security functioning, that markets were not going to meet and had to be met by government. So that, I think, is not industrial policy in the traditional sense of let's pick winners and losers. It was let's fill holes that the private sector simply isn't filling, and those are holes of economic and national security.
So from your perspective, the overall approach you don't take much issue with.
No, I really don't.
So how do we end up with where we are, where we have increasing deficits and increasing debt?
Oh, wait a minute. What I talked about was the proposals.
Yes.
No, I think we're in a terrible place, David, because unfortunately, once you get to legislating, there's a lot of talk. but the talk is always divided politically between the Republicans who refuse to raise taxes and the Democrats who won't deal with entitlements. Now, I think there is a reality to this. About 60% or something of the increase in the debt from 2000 to 2022 was because of the tax cuts. So if it hadn't been for that, the debt, instead of being 100% of GDP, would be about 60%. Another way to look at it is exactly what I just said, which is what percentage of debt, what percent would the debt be of GDP if we had the two tax cuts? And you come out to about the same number, around 63%, something like that. So I think in very large measure, what happened is we had two very big tax cuts, neither of which were paid for. So we decided not to pay for what we were spending, and that's how we got where we are. But looking forward, we're going to have to deal with both spending and taxes. So I think for the reasons I just said, when you get realistic about it, I think you're going to have to be largely on the tax side.
Bob, it's really been great having you on Wall Street Week. Thank you so much. That's Bob Rubin. He's the former Treasury Secretary. Coming up, private credit continues its march to the sky. We talk about how far it can go with Purnima Puri, head of liquid credit at HPS Investment Partners. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. Credit drives the U.S. and global economies, and we've gone from a world where some worried there was too much credit, and now some people are questioning whether there's enough. To help us understand the issues, we welcome back Purnima Puri. She's HPS Investments Head of Liquid Credit. So Purnima, great to have you back on Wall Street Week. I never thought I'd be talking about this because we thought we'd loan too much money. Now people are saying there's not enough supply. People are looking for it. Where are we on the supply demand for credit?
Yeah, so there was no supply last year, or very little supply, anemic, as they like to say. I think what happened is that you saw a big bond market rally, obviously, sort of in the fourth quarter of last year. We came into this year, and the capital markets opened up for business again. People were feeling a lot better about the world. People felt like the Fed had sort of landed this soft landing, I guess. And you can see it. The market's priced quite nicely for lots of cuts. And so you've seen a lot of supply. You've seen most of that supply in the high yield and loan markets and really high quality issuers. You've seen a lot of investment grade supply, and you've seen a lot of treasury supply. And I think that there's a couple reasons. I think one is that most folks are worried about the economy slowing towards the middle of the year. So the Q2 bottom is sort of what the narrative looks like now. So getting in front of that is number one. I think number two is there is a lot of demand for credit right now because absolute yields are relatively high, and so the market's open back up. And three, people are worried about the election cycle as you sort of move forward in the course of the year and whether that's going to create a lot of volatility, which will impact the ability to bring high-yield issuers and loans to market.
So as a practical matter, if you have more demand for the credit, it drives the price up of the credit and it drives the yield down. It gets cheaper, as it were. Are you getting paid these days for the risk you're taking in credit?
So spreads in credit, if you sort of go up and down the stack, investment grade is sort of 100 over, and high yield is 350, 360 over. Loans are low 500s over. Spreads are pretty tight in investment grade and in high yield. I think I saw a statistic today that high yield spreads were as tight as they have ever been post the GFC.
Wow.
So they're tight. Loans are not. Loans are sort of in the middle. Non-recessionary average loan spreads are in the low 500s. That's where it sits today. I think the difference, and this is kind of the problem, is that yields are high and spreads are tight. And so when yields are that high, you have a little bit of cushion. If you're a little bit wrong on spreads and spreads back up a little bit and go out by 50 basis points or 100 basis points over a couple of years, so you're not making, 8 to 9% in high yield bonds, you're making 7.5 to 8.5% in high yield bonds. So I think that in the context of what are the options in the market today, credit's far more compelling than equities for a variety of reasons. Yields are pretty high, and rates, despite the short end coming in, are likely to stay somewhat elevated on the back end. So that spread plus the base rate gets you to a yield that kind of makes sense for people.
There's been something of a conversation going on between the markets and the Fed about exactly what they're going to do in terms of cutting.
Yeah.
How much they'll cut, how fast they'll cut. What is the market pricing in right now on that? And what happens if they're disappointed?
Yeah,
what
it's two different conversations. Yeah. So the Fed dot plot is 3 25 basis point cuts. The market is pricing in 5 or 6 cuts this year. And that's a lot. Our view is that the market is kind of priced for perfection. So, if the Fed were to deliver 6 cuts, the question is why? Yeah. And if it's a recession, that's not great. If the Fed doesn't deliver it, the market's expecting it and expecting it in the context of a soft landing. So there's not a lot of room for error.
What about that possibility of a troubled economy that would require that many cuts? I mean, we spent a lot of last year with economists and people saying we're going to have a recession, we're going to have a recession. Didn't happen. Now it seems like we're saying, no, not going to have a recession. Where is the credit market right now in pricing in the possibility of a recession? Not just a slowdown, but a recession.
The credit market is not pricing in a recession. Spreads are as tight as they've been. And in fact, I was looking at some numbers. It's just an interesting notable that if you look back to the beginning of last year, spreads were close to 500 over on the high yield market, I want to say, versus kind of, we said 360-ish today. Treasuries are exactly at the same place.
When people are financing these days, are they moving over into credit away from equity?
It seems like there's a decent amount of demand for credit right now, for sure, across the board. I mean, ranging from treasuries to investment grade, because that's another way to play that rate trade, to high yield, to loans, to private credit. There's a lot of demand.
I don't know if it's a conversation or whether it's more of a tug of war between private credit and liquid credit, syndicated, things like that. With reports that the banks are trying to get back into that business, take some business back away from private credit. Are you seeing that?
Yeah, I mean, look, the supply in the markets there's been a lot of supply across loans and high yield bonds and investment grade in January. That supply has come through the banks. That's come through the banks because there are buyers that are back that are buying liquid credit. So you're definitely seeing that today. And if that trend continues, some of those big mega, there were mega deals that were done in the private credit space, that were $3 billion, $5 billion in size last year that were really mega cap deals. I suspect that if this trend continues, you won't see as many of those mega cap deals. The rub is if it doesn't, and if there is volatility, and if the Fed doesn't deliver 6 cuts and they deliver 3 cuts, and if there's slower growth, this is going to go back the other way, because there's one variable, which is that there's a lot of companies in 25 that need to refinance their debt. And what that means is that they oftentimes come to market a year in advance of 2025. So you're going to see a lot of paper that actually needs to start to get refinanced in the marketplace. And so this question of whether the markets are going to sort of stay open, if you will, to allow for that to happen in the syndicated space is really the question that will happen. And that's the relevant question for whether this private credit trend will continue.
How much market share can private take away from the banks?
Well, the estimates are that private credit is going to grow by 15+% a year.
Right.
So,
but it's still a relatively small portion if you look at total amount of loans, right?
It's 5% of all the credit out there.
Exactly.
Yeah, totally.
So even if it's growing 15%, it takes a long time.
It takes a long time. But remember, private credit is not, there's been this narrative about it. It's not sort of credit out of thin air. As you said, it's credit that was underwritten by banks. Yeah. So that's one place. It's credit that was underwritten by syndicated investors. That's another home that it's coming from. And there's even, and we're seeing in some of the insurance companies, private investment grade. There's a lot of flow that's going to the land of private credit. I don't see what's going to make that stop.
What's mispriced right now, quickly?
I think treasuries are going to stay anchored in this sort of 10-year 4.5%, which means that I think credit generally is a pretty good place to be. Yeah. I would say probably loans are more interesting just because we don't believe the Fed's going to cut that much. So that's probably an interesting place.
Purnima, it's great to have you on Wall Street. Thank you so much. That's Purnima Puri of HPS Investments. Finally, one more thought. A goal without a plan is just a wish. So wrote Antoine de Saint-Exupéry in The Little Prince 80 years ago. There's no shortages of wishes these days, from wishing to become president, again, to wishing to win a Super Bowl, some maybe for the first time. But the question is whether we can come up with a plan to make our wishes come true. Fed Chair Jay Powell certainly had a wish to bring inflation down. That's after his wish that it not be there in the first place didn't come true.
I think we're experiencing a big uptick in inflation, bigger than many expected, bigger than certainly than I expected.
But he promised that if it did come, the Fed had the tools it needed to handle it.
We will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more.
And as of right now, it looks like his plan is working.
You see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table.
Florida Governor Ron DeSantis had a big wish to be the next president.
I'm Ron DeSantis, and I'm running for president to lead our great American comeback.
But it looks like he didn't have enough of a plan to get there, so he dropped out of the race last Sunday.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now.
Bob Iger had a plan as well as a wish to make the Walt Disney Company the biggest, most successful entertainment company in the world.
Disney has a unique ability to grow strong brands and expand fantastic creative content, as we've proven with our successful acquisitions of both Pixar and Marvel.
And for years, his plan worked better than just about anyone could have expected.
They are the #1 company today as an entertainment media company, without peer.
But the plan to move into streaming proved more difficult than people thought, leaving Bob, like other entertainment CEOs, searching for a new plan for a new age.
Originally, when all these services launched, it was the library that brought people there and the originals kept them. It's now flipped the other way.
Even as Netflix moved into the live entertainment or sports arena with its deal this week with the WWE. On the other hand, I'm not sure how many people had a plan for generative AI to transform the world. Chipmaker NVIDIA's plan started out to make the gaming industry come alive, but it turned out to be just what the doctor ordered for AI. And right now, NVIDIA's wishes, as well as its shareholders, are coming true. Which, of course, brings us to the Detroit Lions, the team I grew up rooting for back in Flint, Michigan. No matter how bad it got, and believe me, it got bad, we Lions fans clung to our wish. Never mind that they posted the worst 8-year run in NFL history from 2001 to 2008, and never mind that they accumulated more losses cumulative than any other team apart from the Arizona Cardinals. But that was then, and this is now, as the Lions play for a slot in the Super Bowl this coming Sunday. Sure, they have a franchise quarterback in Jared Goff.
Yeah, I think the quarterback is often a product of what's around him, and obviously I got a lot of confidence in myself, but I got a lot of great players around me who have helped me out this year and made things easier.
Sure, they have a one-of-a-kind coach in Dan Campbell.
This is where we wanted to get it, right? This is where we wanted to go. This is, for all the Lions fans, this was the whole idea, right? And I know it's, everybody been dying for it for so long, but this is the point.
But it all started with a wish to win and a plan to get there. And that wish and that plan came from Sheila Ford Hamp, a scion of the Ford family who took over as principal owner when her mother passed away. By all accounts, Ms. Ford Hamp brought to the owner's suite something that had been sorely lacking, a single-minded, passionate quest to win, whatever it took, and surrounding herself with the team she needed to get us there. Maybe the Motor City truly is on its way back.
You see, it's the hottest fires that make the hardest steel. Add hard work and conviction, and the know-how that runs generations deep in every last one of us. That's who we are. That's our story.
That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.